All right, welcome everyone. Thank you so much for joining us. My name is Natalie Paoli. I'm the Alumni Outreach Coordinator at Mount Hood Community College. We're so excited to have you here with us today, our students, alumni, and others in our community, and to bring you this phenomenal presentation, Personal Finance, Your Path to Financial Freedom. A couple of housekeeping items before we get started. Please mute yourself if you're not speaking. And we would recommend using Speaker View for the best experience, the side-by-side Speaker View. We've set aside 10 minutes for Q&A at the end of the presentation. So when the time comes, I'll invite you to add your question to the chat or raise your hand and I'll call on you to unmute and ask your question. We'll also be sharing the PowerPoint and the recording of the presentation through email after the event. And now I'd like to go ahead and introduce our fabulous presenters for today. Samantha Paulo is a Senior Vice President of Portfolio and Wealth Management at Ferguson Wellman. Samantha is a certified trust and fiduciary advisor and an accredited wealth management advisor with over 15 years of experience in finance and accounting. She specializes in helping individual clients and their families manage and protect their wealth through wealth planning, investment management, and legacy guidance. In addition, Samantha is a proud alum of Mount Hood Community College and earned her bachelor's degree in business administration and accounting from Portland State University. And Jason Norris is a principal at Ferguson Wellman and heads up equity research for the firm. Jason is a chartered financial analyst and oversees large cap equity strategies at Ferguson Wellman. He is also a member of the investment policy committee guiding asset allocation decisions for the firm's client base. As a portfolio manager, Jason serves clients in Portland, Boise, and Twin Falls, including the Mount Hood Community College Foundation. He earned a bachelor's of business administration and economics from Boise State University and an MBA in finance from University of Notre Dame. Please join me in welcoming Samantha Paulo and Jason Norris.
Thanks, Natalie. Gosh, it's so weird to hear my bio. Being at a Mount Hood Community College event and remembering sitting by that giant fireplace in the student center, thinking about where were my accounting studies going to take me. So it's a pleasure to be here today. I know Jason and I are both really excited to have a chance to talk to all of the folks attending today about personal finance. So we are both portfolio managers with Ferguson Wellman Capital Management. We are a registered investment advisory firm, and we work with individuals, families, and institutions who have worked hard during their life or organizational lifetime to build wealth, and we manage assets starting at $1 million. And a lot of times we are working with our clients and their families, including their children, to talk through how to build that wealth and how to manage their assets through all of their life stages. So today we want to talk about what is a financial plan and why does it matter? Why is it important to have that in your life? And we know that financial planning can be overwhelming and complex. So how do we break that down into a hierarchy of planning needs? Part of our conversation today is going to be talking about principles of smart investment management, because after all, when you're working through personal finance, you're essentially trying to build wealth that will sustain you through your retirement or meet other financial goals that are important to you. Then we're going to break it down into stages. So there's so much we could cover in personal finance. Our goal today is to have you feel like you can approach your finances and figure out what stage of your financial life you're in and how do you focus your time and energy in each of those stages to have the most impact for your investment in your own financial plan. At the end, we will talk about how to get advice and help if your plan is complex and you need more support and some other resources. And of course, we'll take some questions. So what is the financial plan and why does it matter? I think most people generally understand the theory of financial planning. It's putting numbers and projections and figuring out how much do you need to save, what do you need to retire. But you can really think of it using an analogy. If you need to get to a destination that you've never been to before, you're going to take a road trip, you know it's somewhere in Eastern Oregon, but you're not exactly sure where. Do you just get in your car and start driving that general direction and hope that you're taking the right path and will get to that place at the right point in time? Well, obviously, no, it's a silly question, but financial planning is much the same idea. There's a financial point in your future that you haven't been to yet. you can begin to figure out what does it look like and work backwards to figure out what's the path to get there. What's my primary route? What if something goes wrong along the way? What are some of my backup routes? And how long do I think it will take me to get there? That's essentially why financial planning is important, and a simpler way to think about it. Now, another way to break down financial planning is to think about it in a hierarchy of needs. You can't think about tax efficient charitable giving if you haven't taken care of your own emergency funds and risk management. So when you're thinking about where you're at in your financial plan, start with a hierarchy like what we have on screen and focus on the key foundational items at the bottom. Do you have a good budget and emergency fund? Do you have appropriate risk management in place? And then build up from there. Then you can start to build a nest egg and build and your retirement plan. When you know you have adequate resources, think about strategic gifting and benefiting those charitable organizations that are meaningful to you in a tax efficient manner. Now, the way that we want to break financial planning down today in hopes that this is more manageable for each of you is to think about your life stage. The first is early career. A lot of the students on the call here are probably in early career or entering early career, depending on your situation. In your 20s, possibly managing your own household for the first time and have a full-time good paying job. Then mid-career tends to be in your 30s to your 40s. You're deeply built in your career. You might have family at this point. You're building up assets. So your goals and values at this point have changed. And pre-retirement is generally in your late 50s to 60s. You're 5 to 10 years out of retirement. Hopefully you've amassed a considerable amount of assets now, and you're trying to figure out how do you enter that retirement period. And then of course, the fourth stage is retirement. Now, before we dive into each of those, I'm going to hand it to Jason for a moment, who's going to talk about the key principles in shepherding your assets and investing those over your financial life.
Great, thanks, Sammy. So when you're looking to build that nest egg and prepare for retirement and invest that money to let it grow, there's 5 key things you need to be aware of. And the first is know your time horizon. Investing, especially in the equity market, can be risky. And so buying risk assets, if your time horizon is very short, may not be warranted because you can lose money. So we're going to talk about that. Diversification. There are a lot of different investment opportunities, stocks, bonds, real estate, et cetera. And having a little bit of different options reduces the risk of your portfolio. And it also allows you to take advantage when growth is in one area of the economy or asset class while not in the other. Rebalancing just makes sure your asset allocation is where you want it to be. If stocks do really well over several years, you might want to trim those back because they become a larger part of your portfolio, and just to manage your risk. Manage expenses, depending on how you invest. The key is there are costs, and so just being aware of those costs. And finally, don't time the market. There's a quote that more people have lost money trying to time the market than going through a bear market and coming out of it. And if you've been watching the market the last 2 days, that's really key, primarily because the Dow opened down 1,000 points yesterday and ended positive. And it looks like it's going to do the same today. So trying to trade around the market for long-term investing is not wise. So when you look at investing in equities, Sammy, could you go to the next slide? Time horizon is important. If you have a long-term time horizon, you look down there, the 15-year periods, stocks are positive 100% of the time. So you want to take on more risk and have a large allocation to equities. However, if your time horizon is short, that's where added risk is. While stocks are positive roughly 70% of the time in any given year, they also are negative. And those negative periods can be great. So if you have a short time period, you do not want to have a lot of assets in equities because that increases your risk of losing money. While if you're young, just starting out in your career and starting saving, then you want to be very aggressive because over the long run, equities perform a lot better than other asset classes. Which brings us to identifying your goals. There's short-term goals. I'm going to go back one. Thanks. Short-term goals, medium-term goals.
Sorry, Jason.
It's all
The
right.
slide deck's a little bit jumpy. I'll get there. Keep going.
No problem. So on short-term goals, let's say you are, emergency savings. You're saving for a house you may want to buy within a year, or you're getting ready to start college or pay for your kids' college. You want to have those primarily in cash or very risk-averse investments, because you do not want to lose that principal. You give up return, but you are getting safety. Medium-term goals, if you're looking at 5 to 10 years, let's say you anticipate maybe buying a new house in several years, you want to add risk to the portfolio, adding more in equities, which is the dark blue. However, you still want to have some in some non-risky asset classes just to ride out the volatility, because while stocks go up over the long term, there are periods of time where you can lose money. Finally, longer term, you want to increase your allocation to risk assets, being equities, and have a lower allocation of fixed income. And we also have put in this alternative asset class. This would be real estate, real assets, other non-stock or non-bond investments, primarily in this environment where interest rates are very low. Investors and savers need to find other means to generate income and return in a low yielding environment. So there's a small allocation there. So the key is knowing what your goals are and the time horizon, and that really should drive your asset allocation. And this can be highlighted on the next page. Just looking at this is over the last 20 years. We like to call this a quilt, and it highlights different asset classes in the best performing to the worst, and with the best being the top and the worst being the bottom. And what we've done is we've highlighted cash versus large cap US stocks. And you can see there's a lot of volatility on any given year between cash and stocks. But over the course of time, if you can see that blue box is usually in the middle or at least the top. So over any given year, large cap stocks do well. And cash, while very little returns, provides a lot of safety, but always a positive return. And so when markets are down, as we saw in 2001, you can see stocks were down 12, cash was up 4. And so this is why when you have a short-term time horizon, putting a lot into stock adds risk, and this is when you want to be in cash. And this is also the importance of diversification. There are a lot of other asset classes on this page. So if you have a little bit of different asset classes, it makes your ride a little bit smoother. Finally, as Sammy commented on timing the market, if you try to time the market and say, in essence, day trade, you can miss out on great opportunities. This chart looks here at being fully invested, as well as missing certain days of the market because you're trying to time it over the last 20 years. So if you're fully invested, you can turn $10,000 into just a little over 36. However, if you're trying to time the market and you miss the 10 best days in the market of the last 20 years, you cut your returns in half. So trying to anticipate sell-offs and sell before, and then also having to buy back is important. If your time horizon is long, staying fully investing and rebalancing is the best way to grow your nest egg and grow your wealth. And I'll pass it over to Sammy to move on to the stages.
Thanks, Jason. Okay, at this point, we're going to take a closer look at each stage, the common goals and issues at that stage, and cover a couple of tips for improving your own financial condition or plans in your stage. So as we go through, kind of think through where are you at and what items have you already nailed and what should you prioritize with your plan this year. So the first stage is early career. As I said earlier, this is sort of in your early 20s. You're really kind of starting your adult life. And it's important at this stage to make sure that you are getting comfortable with a budget, that you understand your cash flow and are living in the black, meaning that you are spending less than you make, thinking about what are your needs versus your wants, and building an emergency savings. This is at the bottom of that triangle. Think about developing responsible debt usage and starting to build your investment acumen and start to outline what your short, medium, and long-term goals are. At this point, you're still quite young and you have a long life ahead of you, so those goals can change a lot, but having some idea of what those are can help you move in the right direction. One of the questions that we often get from folks who are in this early stage is, okay, I've got my budget, I am saving, but how do I allocate those dollars saved across all the different kinds of accounts that are available to me? So what we have on screen is a way to think about prioritizing where you put that cash that can then get invested. And each of the boxes is a type of retirement account, with the highest priority being on the left-hand side of your screen. So the first thing you want to make sure that you fund is an emergency savings fund. Most advisors would agree that you should have between 3 to 6 months of basic living expenses covered. That's just in case you lose your job or you have a health emergency and you don't have disability coverage and suddenly you need some additional cash for a period of time. And back to what Jason was saying earlier, that's a short-term type of account. You might need that any minute, any day. So it should be highly liquid and generally in cash, or something like a CD that's going to have a lot of principal protection. Moving to the right, the next thing you want to focus on are getting those employer matches. So for any of you who are working for an employer that has a benefit plan, most employers will offer a match where they're incentivizing you to contribute assets into, for example, a health savings account, which is a tax advantaged account for saving for medical expenses, or your retirement plan like your 401k or 403b. And this match money is essentially free money. So making sure that you get up to that match so that you can get all of those funds. Next is to think about your debt. So if you have accumulated high interest rate debt, before you start saving into the other accounts moving to the right, which is your finishing up your retirement contributions or IRAs or a taxable account, you really want to evaluate your debt. If you have debt that has high single interest or high single digit or double digit interest rates, it's important to pay that debt down because you likely can't match that level of growth in an investment account, and you'd be losing out between the trade-off in your interest rate paid and the growth earned. So pay down that high interest rate debt, then move to the other accounts in this priority and fund those. So we're talking about savings and starting early to build that retirement over time and that good savings strategy. We want to drive home the point, and I know a lot of you have heard this, it is important to start early, and it absolutely is. What we're showing you on screen here is the difference between someone starting at age 20 and at age 40, saving $2,400 per year, which is $200 per month. The same savings rate with 20 extra years of compounding equals $877,000 of difference in growth. And if you do the math, the difference in contributions is only around 40 to 50,000. So all of that extra growth that you have at retirement is because you started early and the earnings on your dollars were then earning on those dollars, essentially snowballing into incredible growth. This is how, in today's day and age, we build up our own retirement safety net. Jason, I'll hand this back to you.
Yeah, and just to follow up with that, with the savings, the previous chart showed a kind of a straight line, and as we know, longer term investments are a little more volatile. And this chart shows a 30-year time horizon of an aggressive with a high exposure to equities, and you can see there are great periods. You can get 30% in a year, and you can also lose 35% in a year. But over the course of time, longer term, you can get close to 10%. And which is why when you have that long-term time horizon, having an aggressive high exposure to equities makes sense, but also understanding the risks is that in short periods of time, you can lose a meaningful portion of your investment. So knowing your time horizon is key, and we're going to stress this throughout the presentation. Go ahead, Sam.
Thanks, Jason. So in early retirement, in early career, those savings that you're putting into those retirement accounts, as Jason said, really should be leaning into growth, and don't touch them, let them grow. The next stage is mid-career. So this is generally in your 30s to 40s. Usually you're earning at a higher level. You may have a family, children, you might have a home, you're accumulating assets. Also, at this point in time, it's sometimes easier to develop clarity around what your life is going to look like. Maybe you know where you're going to live, you know what your family structure looks like, you have clearer goals. It's a good time to reevaluate those goals and what it will take to get you there. Other things to consider at this stage are protection planning. With more assets that you've built up and potentially a family, it's important to make sure that you have plans in place to protect them if something happens to you or an event of a liability concern, like someone falls on your property. Also, at this stage, you should be working, if you're not already working, to maximize your retirement contributions, and it might be time to think about getting a tax advisor involved with higher income and more complex assets. A tax advisor and the cost of their time can well be worth it based on the additional tax strategy or optimization that they can provide. Speaking of tax advisors, this is a look at how income generally tends to change over one's lifetime. Obviously, it will be different for every person, but if you look at the far left, we've got young in your 20s. They should be your lowest earning years as you're just setting out in your career path, and moving into your 30s and 40s, you're kind of moving up, maybe your mid income years, and then of course, closer to retirement, you should be earning at your highest years. So in the mid-career, tax planning can be a little complicated because you may be in middle tax brackets. And for those of you who are not familiar, the US tax system is progressive. So when you earn just a little, the percent of tax you pay is lower than if you're earning at your highest point, you're paying a higher percent of every dollar in taxes. So which types of retirement accounts you fund and certain other strategies really can change as you move into mid-career. So for example, when you're young, a Roth type account is a great choice because you have really low tax rates. You might as well pay tax on that now and put that into a Roth retirement account where it grows tax-free and can be taken out tax-free in retirement. As your income tax rate rises, however, it might be good to start using tax-deferred retirement accounts where you get a deduction now at a high tax bracket in hopes that when you take it out in retirement, you'll actually pay at a lower tax bracket. The other point we want to drive home with mid-career is protection planning. We've put up 5 key areas to think about. You can print this out and just check them off, making sure that your protection planning is in place. So the first is insurance, making sure that you have home, renters if you're renting, auto insurance, and an umbrella policy. An umbrella policy sits over the top of your other policies. Because it's a backup, it's often quite affordable, and it just kicks in if you have an event where the claim is higher than the limits on your other policies. So it, for a very cheap price, can offer a lot of peace of mind. Because of COVID, we have had a major increase in those who are self-employed. So it drives home the point of business entities. If you are thinking of starting your own business or you are running your own business, make sure that you've looked into putting a business entity around that, which will essentially create a level of protection for your personal assets from any liabilities that occur in your business endeavors. Other things to look at are the account types. So retirement accounts tend to have higher protection from creditors in the event of a lawsuit or bankruptcy. And of course, if you're entering into any kind of partnership structure or moving in with a spouse or getting married and you have disproportionate assets, evaluate legal agreements with your attorney to make sure that you're protecting each other. And finally, an estate plan, possibly one of the most important parts, particularly if you have family, is making sure that you have an estate plan that gets all of your goals properly documented. It has the right people making the right decisions for you. For example, healthcare decisions, or managing finances if you're incapacitated, and certainly making sure your assets go to the right people if something were to happen to you. Oops. Boy, I'm really struggling with this deck today. All right, Jason. Investing for your goals mid-career.
Yeah, so it's as you transition through life, you actually have different buckets when you're looking at your investments. You could be saving for a house, which could be very short term, or paying for college, either for your continuing education or your kids, which could maybe medium term. So assessing the needs of these different buckets, as well as retirement, requires either to separate your savings into a savings for a house, college, and then retirement, to ensure you're not taking on risk, as well as ensure you're not leaving opportunity on the table. The last thing you want is to be too conservative while you're younger for your retirement savings and not save enough because you were left all your savings in cash rather than focusing on the growth in a retirement account. So just understanding that time horizon and where you are in that cycle or on that highway is really important going forward.
All right, next is pre-retirement stage, and this doesn't need a whole lot of description. This is in the 5 to 10 years before you retire. Oftentimes, the most important goal or concern on people's mind at this stage is how do I prepare for retirement? Am I ready? Will my assets support my needs? At this point, it can be really valuable to work with a professional if you haven't already. So a financial advisor or a financial planner to put together an accurate and robust retirement projection. It's also a good time to revisit the estate plan if it's been 5 to 10 years since the last time you looked at it, as your family and decision makers might have changed. And this is a great time to evaluate long-term care insurance. The pre-retirement, you're generally close enough to those retirement years that you're not paying for insurance for decades where you won't need it, but you're also young enough that you're probably pretty healthy and can get great rates on the long-term care. This is a checklist. I'm not going to go through all of these, but we wanted to include it in the deck so that for any of you who are getting ready to retire, you can use this checklist to make sure that you've thought about the main issues and planning items to get nailed down before you actually make that decision. Essentially, it's important at this stage to think about how will your lifestyle change in retirement. A lot of times we're working, we're busy, we're sort of on autopilot, but take some time to think, how am I going to spend my time? And will that change in how I spend my time? Will it change my budget? Will I travel more? Will I have a new hobby that's expensive? Will there be things that I stop doing that actually save me money? And really putting together a budget and then sort of pro forma-ing that, put together something that looks like it's going to reflect your retirement lifestyle and spending needs. With that information, you can assess your assets, you can reevaluate your time horizon to retire, and think about your appropriate investment allocation once you transition into retirement. Jason.
So as we as we moved closer to retirement, asset allocation is very important. Your exposure to stocks, bonds, and then alternatives, as I mentioned, which could be real estate or real assets. So we call this the new 60-40. Historically, when people got close to retirement, a 60-40 portfolio made a lot of sense. That meant 60% stock, 40% bonds, because at that time, stocks would give you 10%, bonds would probably give you 6%, and were very safe. So you could get a nice high single-digit return with 40% of your assets in safe bonds. Right now, unfortunately, bond yields are giving you 1.5 to 2%. And so that high exposure to bonds, especially getting closer to retirement, can be a headwind because it's not even keeping up with inflation. So, we recommend to our clients to add a little bit more to stocks and take some more out of bonds and add it to the real estate and real assets and other asset classes. It increases the diversification of the portfolio, provides additional income. It does add a little bit of risk, but it's just the standard, your father's 60-40 is not applicable today just because of the interest rate environment we're in.
Great point, Jason. And I just want to drive that home before I move into the next one. There are a lot of investing rules of thumb that were reasonably accurate in historical different economic environment, a high interest rate environment, you could go with a certain rule of thumb. Gone are the days of the 60-40, or there was another rule where you take your 100 minus your age, and that tells you how much you should have in stocks. That generally those kinds of rules don't work anymore. So be careful about using rules of thumb and make sure that you're following guidelines that are developed for our current economic environment. All right, the last stage, or the fourth stage, is the retirement stage. And this is often marked by a stress of transitioning from saving. So you've spent decades building up your retirement fund, and now you have to transition to spending down from that. Some folks who enter retirement are lucky enough to have some guaranteed income sources. In Oregon, we have a lot of folks who benefit from PERS. But going forward, those of you who are younger and planning, you will likely have to live off of the retirement accounts that you've built up, because we've moved away from a society where we have a lot of reliable pension plans. So thinking about moving from saving to spending, being thoughtful in how you're withdrawing from your assets. So over a whole lifetime of savings, you've probably developed assets in a lot of different types of accounts. You may have a taxable brokerage account, your checking and savings, a tax deferred IRA or 401k, and then maybe a Roth. Each of these has different tax attributes, and the order in which you withdraw them can change how long your assets last in retirement. A couple of other things to think about. Jason already mentioned incorporating income into your investment strategy in retirement to help smooth out your need for withdrawals. And then of course, at this stage, estate planning, incapacity planning, and health planning are a little bit more important. So make sure that you understand your health needs and your health coverage, and that your estate plan is accounting for incapacity as well, making sure that you've got a good successor trustee or agent under a power of attorney that's in place to take care of your needs if you're not able to do so. So I want to spend a little time talking about this idea of tax efficient withdrawals. So I said a moment ago that you probably have a bunch of different buckets entering retirement that have different tax attributes. Most financial advisors would agree that you want to avoid drawing down your assets in the way that the yellow bar on screen shows. So what we're showing you here is how your net after-tax wealth lasts a lifetime, depending on how you withdraw those accounts. So if you take from your traditional IRA, you're paying taxes on all those assets and pulling them out of that tax deferred compounding, and it quickly exhausts your wealth. The more desirable strategies are in the gray, red, and blue, each requiring a little bit more complexity. So the gray one is switching that order and taking from your taxable account first, then your IRA, and then at the very last your Roth. That is generally a good rule of thumb to follow. A better one in some cases is to pull pro rata from all of those accounts. And that is because when you enter retirement, oftentimes your income has just stopped, and you may be in an incredibly low tax bracket. So that's a good time to take some assets out of your IRA. And finally, if you're up for the challenge and have a good tax advisor or financial advisor involved, making serial Roth conversions during those early years of retirement, that is the top line and can have a considerable impact on how long your assets last. That's where in those early years, you take some out of the IRA and put it into the Roth and pay tax on that, essentially prepaying the tax at low tax rates. Everyone's situation will be very different. Who knows how much you have in each bucket, what your individual income tax situation looks like, but we want you to realize how powerful this decision can be and make sure that you are getting some advice or thinking through this before you start taking your withdrawals in retirement.
So here we just wanted to highlight, as we took that journey through retirement, how your asset allocation would change. The left pie chart looks at early stage. If you're in your early to mid 20s, you want to be positioned fairly aggressively. You can see there's no fixed income, there are no bonds. If your time horizon is 40 years, there is no need to have any bonds in your allocation. So you're fairly aggressive. international stocks, US small cap as well as large cap, and those alternatives. As you move through your life cycle, get closer to retirement, you need the safety of bonds. Even though interest rates are low, bonds still provide great insurance in times of stress. And so if you are spending or using your retirement savings to live off of, you need that safety net in your portfolio. We get the question now what interest rates are, why would I own any bonds? And if you look back in March of 2020 during the pandemic, the best performing asset class was the government treasury, which was up 10% and stocks were down 35. So while yields can be low, they do provide great insurance and great safety and are very appropriate for those who especially are living off their portfolio.
Thanks, Jason. All right, so that wraps up our core presentation. We've just talked to you about the different stages, key issues at those stages. If you, thinking about your own plan, feel like you need additional help, there are a number of different professionals you can reach out to, tax advisors like CPAs, attorneys, financial advisors. Our recommendation for how to pick a good advisor is to start by asking people that you know and trust for someone that they know and trust and have hopefully worked with for a number of years and feel confident in their integrity and skill set. It's always good to verify a professional's credentials with an industry website. You can also look on those industry websites for any disciplinary action or complaints in many cases. And then we recommend interviewing more than one advisor and asking for references. It's good to make sure that when you're interviewing that you feel good about the connection with that person, they understand you, you're comfortable talking to them, because with planning, you're going to tell them about a lot of personal details in your life. So it's important to feel like that's a good, reliable relationship. You have quite a few resources, frankly, through Mountain Hood Community College. There are 2 courses on the topic of personal finance and retirement planning. We put a link up here. For those who need some additional financial assistance, there is tax and legal help through Cash Oregon and PCC Clear. And then we've put some websites up here that can provide some additional information on tax planning or tax questions. And then from the 2 of us, we've put together some books, websites, and subscriptions if you're interested in deepening your own investment and financial acumen. And one that's not on here is Morningstar. Morningstar.com has quite a bit of good personal finance advice. It's a great place to look for some general personal financial questions. We have some disclosures here that you will see when you get a copy of our deck. And now we'd like to take questions.
All right, everyone. So at this time, the floor is open for questions. Please feel free to use the chat and unmute yourself to ask a question if you'd prefer to do it that way.
Hey, Sammy, there's a great question for you in the chat. I don't know if you saw it. It says, is there a value in doing Roth conversions during earlier stages of life if you have a year of lower income?
Yes, absolutely. Great question. It's a good time if you have a year of lower income. So maybe you're between jobs, which a lot of people have been in the past year. That's a good time to do a Roth conversion. Another time that can be really strategic is if you already know you're going to do a Roth conversion. So one of the benefits of planning ahead is, yes, I'll be in low income this year, and you're ready to do a conversion. And then if we have a market pullback like what we're experiencing right now, doing Roth conversions in a down market is better than doing them in an up market, because you're essentially rolling over assets at depressed values, and you'll have to pay tax on the value of those assets when you roll them over. Thanks, Maura. Good question. I see some good comments in here, just looking for other questions. We have 37 people. There's got to be some more questions. Natalie, do you have any?
My head is spinning a little bit. I think I'm still digesting all of the information. I guess mine is more of a, let's see how to put it. In talking about kind of the ages you're supposed to be in these different stages. I know for myself and a lot of others in my generation, we're coming to our like early career point, like almost a decade later than our parents did. So what advice would you have for folks who are feeling like, I just stopped living paycheck to paycheck, but my age tells me, I should be farther along?
That's such a good question. I'm glad you brought that up because the ages I threw out, take that with a grain of salt because every situation is different. But you're right. That early career stage has been pushed back a bit as our economy has evolved and our generations have changed. A couple of things. First, you'll need to be saving a little bit more than you might if you started when you're 20. So I'd recommend when you put your budget together, save as much as you possibly can and start there. And then a lot of employers they'll have an option to do an increase every year. So you can set that auto increase. It's a little bit of a psychological trick because you just don't see it. It happens automatically. You don't have to go say, okay, I'm not going to go to my coffee shop anymore. It just automatically happens. And it's a great way to make sure that that's done. Something else to keep in mind, there's a lot of discussion about working later into retirement. Historically, folks felt like you're just going to work and then immediately retire. And there's just been a lot more studies around sort of a phase into retirement, which can be really powerful at improving your retirement success. If you maybe leave the high stress job, but then go find something that earns you a little bit, provides you some health insurance, and you enjoy it, you can have a quasi-retirement for who knows how long before you're really living off of your assets. So those are a couple of ways to adjust this. Jace, do you want to take that question on inflation?
Yes. So the question is, will inflation affect the type or amount of investment, I'm assuming for retirement? And the answer is yes. Over the last 20 plus years or last 30 years, we've been in a very low inflation environment that also generated very robust equity returns. And that was the best of both worlds. So if we move to a higher inflation, we don't expect the inflation of the late 70s, early 80s, but even up to, let's say, a 3% versus 2%, that will affect your savings. And this is another reason why we have allocated more funds to equities or to stocks and out of bonds, because bonds right now, if inflation is 3% and your bond yield is 2%, you are losing purchasing power. And just understanding where that inflation is coming from, what you're spending on, because as we get closer to retirement, your highest cost item as you move into retirement is usually healthcare, and the inflation in healthcare is usually a lot more than inflation across the economy. So it's something to review and just to make sure that your investments are keeping up with inflation so you don't lose purchasing power.
There's a couple of good questions on debt here, and I'll tackle both of them. So Amy asked about paying off debt before doing long-term investing. And Amy, I would say it depends on the interest rate on that debt. And you might have could be a couple different kinds of debt. And anything that has a rate over, really over 6 or 8%, I'm going to look to you, Jason, if you disagree. But the decision is really, if you're going to do long-term investing, how much growth can you expect per year on that? And if you're in an diversified all equity portfolio, you might be talking 8 to 10% average annual returns. So it can be valuable to start doing that now and get that 8 to 10%, even if you have a loan where you're paying 5%, because you're making the difference between the 5% you're paying and the 8, 9, 10% you're earning. So that's how I would think about the debt payoff versus investing. But keep in mind also that there's some psychology with debt. If you don't like having debt, or if you're entering retirement with a lot of debt and you'd feel more comfortable paying it off, that also makes sense. And by paying off debt before you go into retirement, you're also eliminating the fixed required expenses that you have every month. So if we are in the middle of a recession, there's less that you have to withdraw to cover that nut on a regular basis. The other question was, how do you balance paying off high interest rate student loans. Okay, so I kind of answered the question there about the high interest rate student loans versus saving for retirement. If they're high interest rate, I would just aggressively pay those down and then start saving as soon as you can. As soon as you pay off one of those loans, immediately turn around and redirect what you were paying towards the loan into your investment account. Don't let yourself get into the trap of then spending that. You're relieved that you don't have this expense anymore. Make sure that you redirect those funds into that savings account. When it comes to the different types of debt, your mortgage debt is, student debt tends to be ideal in that it can be flexible. You have some negotiating power depending on where that student loan is coming from. Your mortgage debt has the benefit of being tax deductible. Personal debt, credit cards, personal loans, that generally falls into the sort of bad debt, less desirable debt bucket because it is not deductible and oftentimes has a high interest rate associated with it.
We had a question from Deborah that was sent to me in a direct message. Does the 4% rule for withdrawals still apply, or how should we determine if we need to adjust that? And how does 7% inflation figure into withdrawals?
Jason, do you want to hit that or you want me to take it?
You hit the 4%.
Okay.
And I'll talk about the inflation at 7%.
So the 4% rule, I would say right now is more like a 3 to 3.5% rule. So the main study that established the 4% rule was done over historical returns during a higher rate environment. So it was a 60-40 portfolio. So make sure that you have adequate exposure to growth equity, at least 60%. You need that growth engine to make that rule work. But I would err on the side of more like 3 to 3.5%. Because there's a chance that you're going to live longer than we did when that study was first done. And also we have been in a low interest rate environment, which generally necessitates lower long-term returns, although that may be changing.
Yeah, and talking about if an inflation environment is 7%, which we do not expect, the recent numbers have been high, but we think that's more of a short-term issue based on the composition of what's really spiking in prices, primarily commodities and used cars. But when looking at, but that's key to your investment portfolio is managing the growth. And if we do get in a period of time where inflation is mid to high single digits sometime in the future, then unfortunately savers and investors will have to increase the risk of their portfolio to keep up. Because if bond yields are below inflation, then you lose purchasing power. So in higher inflationary environment, when interest rates are low, which usually rarely occurs, but even if it were to, then savers need to unfortunately increase the risk of their portfolios or have to save more.
I want to add one thing on the withdrawal rate. Another thing to evaluate for any of you who are in retirement or getting ready for retirement is something called dynamic spending. A quick Google search will give you some of the actual methodologies for this, but instead of using the 4%, which is you take 4% of your portfolio at the start of retirement and then increase that dollar by inflation every year, instead you take in some of the different formulas 5%, and then you adjust up or down depending on how your portfolio is performing. So dynamic spending plans, they require a little more involvement and some flexibility in your spending from year to year, but they really can help prolong that portfolio. Because if we have a couple of down years, you're giving yourself a pay deduction, right? But if we have great years, then you can have a pay raise if you think of your portfolio as your boss, I guess, and increasing or decreasing your pay. And that can be a great way to help make sure that you never run out of funds in retirement.
And we have another question in the chat. Is going to college at the age of 30 plus worth it from a financial or investing viewpoint?
Boy, that depends.
That was my answer as well, unfortunately. Go ahead, Tammy. Oh, it looks like she froze. I guess to the depends is, looking at the cost of college, and then the return, as we know, college is an investment, and so you can get, financially, it may make sense longer term, and so it depends on the situation. So we would. Everyone's situation is different, but usually if you go to college and you end up making more money than pre-college and you have a long enough time horizon, it may be worth the investment.
Sorry, my computer just rebooted itself. So I'm glad we were done with the presentation. Jason, I can't see I dialed in from my phone, so I can't see the questions. If there are any more that come up, will you read them off to me?
Question of what percent of my income should I be saving for college for my kids versus retirement? And how soon should I start saving prior to them starting college? And I'll let you answer that one, Sammy, because I think that's a very interesting question.
Yeah, I can't say what percent of your income you should be saving. We can tell you that the sooner you start, the better. The 529 plan accounts, for example, they're one of the most popular college savings accounts because of their tax advantage features and flexibility. I would start when your kids are under 5 years old and invest as much as you can. There are some great calculators out there. I think savingforcollege.com has a good calculator where you can say, what state do you think your child might go to school in? Are they going to go to public or private? And it will pull the current price of attending that university. And then you can indicate how much you've already saved, how much you can afford to save, and it will do the math for you and tell you how much you need to contribute on a monthly basis to get to that college goal. As far as retirement savings versus 529 plan, my personal preference when working with clients is to prioritize your retirement savings first. It's important to provide for yourself and your future retirement, and there is a reasonable chance that if you're a young parent with young kids, you want to be trying to max out your retirement. And then when you get to college age, you might have enough income to help them just out of your income every year. And at some point in that 0 to 18 years, hopefully you can carve out a little to put in a 529 plan. Great question.
We have John has his hand raised.
Hi. I'm an alum. I currently work in a 401k industry. I am a QKA. And I went, I got a few degrees, mostly at one time through Mount Hood in my late 20s. So I was really wanted to comment on the question about starting education. You're going to college in your 30s. I did not complete my 4-year degree until I think 32. And now I'll turn 42 this year, so a decade later. I was able to get a better job only because of my college education. And it really did prepare me better for different work. While I don't think it made me smarter, it helps build certain disciplines for the kind of work that you're hopefully looking for. Even if you go in a different field altogether. I stayed in the School of Business, but I went to school for marketing. I actually did get a marketing degree from an accredited school. There's only a few of them out there that offer marketing, but I'm not doing marketing at all. So, but I am still in the School of Business. In terms of financially, what makes a difference, that you can't guarantee what kind of job you're going to get. can't guarantee that you're not going to have debt. Student debt, as has been discussed, is pretty flexible and relatively low interest. But there are people that get caught up with that student loans going to different places as well. I didn't have that problem myself, but one of my colleagues is going through that. There's a lot to consider when you're asking, is it smart to start at this age? And when I went through a decade ago, we were in a recession, right? So it's common advice when you're in a recession and you're having a hard time finding work or anything like that, that's usually a good time to go to school if you have the need or desire to.
Thank you, John, for sharing. That was really great insight. All right, we've got just a couple more minutes left here. If anyone has a final question, I'm also going to add a link to our feedback survey in the chat. If you would please take a moment to fill that out. I'm also going to send this link out with our recap email that'll have the PowerPoint and the recording of the presentation.
Thanks so much for having us, Natalie.
Yeah, thank you. Thanks for all attending as well, putting this on. It was great.
Yes, thank you so much, Sammy and Jason, for sharing your insight and your expertise with us. This has been fantastic. Thank you, everybody, for joining. Nice full room today. Really appreciate all of your time and hope to see you at the next alumni webinar.